Hey everyone, it's Shared Both, and welcome back to the channel. Today we're diving deep into the world of project appraisal techniques. Whether you're an aspiring entrepreneur, a seasoned investor, or just someone looking to level up your financial literacy, understanding these techniques is crucial. We're going to break down complex concepts into bite-sized pieces, using real-world examples and practical applications. By mastering these techniques, you'll gain the confidence to make informed decisions, mitigate risks, and ultimately increase your chances of success. This video is your one-stop shop for mastering project appraisal. So buckle up, hit that subscribe button, and let's get started. Let's kick things off by understanding what project appraisal really is and why it's so important. It's a systematic process of evaluating the financial viability and potential profitability of a project. Project appraisal gives you the insights needed to make informed decisions. It helps you answer critical questions like, is this project worth investing in? What are the potential risks and rewards? By carefully assessing these factors, you're making calculated decisions based on data and analysis. Now that we understand the importance of project appraisal, let's dive into the first crucial step, identifying and analyzing potential projects. It's about finding those golden opportunities that align with your financial goals and risk tolerance. It starts with having a clear understanding of your investment criteria. What are you looking for in a project? Are you aiming for short-term gains or long-term growth? What's your risk appetite? This could involve conducting market research, analyzing industry trends, or even exploring new and emerging sectors. The key is to cast a wide net and gather as much information as possible. By carefully evaluating these factors, you can start narrowing down your options and identifying the most promising contenders. Alright, so we've identified some promising projects. But before we break out the calculators and start crunching numbers, it's crucial to understand the various factors that can make or break a project's success. One of the most significant factors is the economic climate. Is the market experiencing growth or contraction? Are interest rates rising or falling? These macroeconomic factors can have a huge impact on a project's profitability. Next, we have to consider the industry landscape. Is the industry competitive or dominated by a few major players? What are the barriers to entry? Of course, we can't forget about risk. Accurately assessing and mitigating these risks is crucial for protecting your investment and maximizing your chances of success. Now that we've covered the key factors that can impact a project's success, let's dive into the heart of the matter: project appraisal techniques. These are the tools and methods used to evaluate the financial viability of a project. Some of the most commonly used techniques include the payback period, accounting rate of return, net present value, internal rate of return, and discounted payback period. By the end of this series, you'll be a pro at selecting the most appropriate technique for any given project. So let's roll up our sleeves and start exploring the fascinating world of project appraisal techniques. Let's kick things off with one of the simplest and most straightforward project appraisal techniques, the payback period. This method tells you how long it takes for a project to generate enough cash flow to recover its initial investment. To calculate the payback period, you simply divide the initial investment by the project's annual cash flow. For example, let's say you're considering investing $100,000 in a project that's expected to generate $25,000 in annual cash flow. The payback period for this project would be 4 years. While the payback period is a useful tool for getting a quick sense of a project's risk, it's important to note that it has its limitations. Moving on to another non-discounted method, we have the accounting rate of return, or ARR. This technique focuses on the profitability of a project, expressing it as a percentage of the initial investment. To calculate the ARR, determine the project's average annual profit. Divide the total profit by the number of years, then divide by the initial investment and multiply by 100. For example, a $50,000 investment generating $25,000 over 5 years. ARR helps compare project profitability crucial for prioritizing investments. Up until now, we've been discussing non-discounted methods which don't take into account the time value of money. But in the world of finance, time is money, literally. A dollar received today is worth more than a dollar received in the future because you can invest that dollar today and earn a return on it. This is where discounted cash flow or DCF techniques come in. These methods factor in the time value of money by discounting future cash flows back to their present value. DCF techniques are considered more accurate and sophisticated than non-discounted methods because they provide a more realistic picture of a project's profitability. Let's dive into one of the most widely used DCF techniques, net present value, or NPV. NPV calculates the present value of future cash flows minus the initial investment, showing a project's profitability. A positive NPV means the project is profitable, while a negative NPV indicates a potential loss. To calculate NPV, discount each year's cash flow to its present value and subtract the initial investment. NPV helps compare projects and make investment decisions based on profitability. In many project appraisals, we encounter streams of equal cash flows occurring at regular intervals. These are known as annuities, and understanding how to discount them is crucial for accurate project valuation. An annuity is essentially a series of equal payments or receipts over a specified period. Discounting an annuity involves calculating the present value of this entire stream of future payments. The present value of an annuity formula takes into account the discount rate, the number of periods, and the amount of each payment to calculate the total present value of the annuity. This concept is particularly useful when evaluating projects with predictable and consistent cash flows, such as rental properties or long-term contracts. Let's move on to another powerful DCF technique, the internal rate of return, or IRR. This method calculates the discount rate at which the NPV of a project is equal to zero. The IRR is essentially the project's inherent rate of return, representing the effective rate of interest earned on the investment. A higher IRR indicates a more profitable project. To determine the IRR, we typically use financial calculators or spreadsheet software like Excel. The IRR is a valuable tool for comparing different projects and determining whether a project meets your minimum required rate of return. Remember the payback period we discussed earlier? Well, the discounted payback period is like its more sophisticated cousin. It addresses one of the major drawbacks of the simple payback period by incorporating the time value of money. Instead of using nominal cash flows, the discounted payback period discounts each year's cash flow to its present value before calculating the payback period. This provides a more accurate measure of how long it takes to recover the initial investment in today's dollars. While the discounted payback period is a step up from the simple payback period, it still has its limitations. Now let's talk about two crucial factors that can significantly impact a project's profitability, inflation, and taxes. Ignoring these factors can lead to inaccurate project appraisals and potentially poor investment decisions. Inflation erodes the purchasing power of money over time. When evaluating projects, it's essential to adjust future cash flows for the expected inflation rate to get a realistic picture of their true value. Taxes, on the other hand, can eat into a project's profits. By incorporating inflation and tax adjustments into your project appraisals, you can make more informed investment decisions that align with your financial goals. In an ideal world, we'd have unlimited funds to invest in every profitable project that comes our way. However, in reality, we often face capital rationing, a situation where we have limited funds to allocate among competing projects. When faced with capital rationing, we need a way to prioritize projects and allocate our limited resources to those with the highest potential returns. This is where the Profitability Index, PI, comes in handy. A PI greater than 1 indicates that the project is expected to generate a positive NPV, making it a worthwhile investment. This ensures that we're allocating our limited resources to the projects with the greatest potential to maximize our returns. So there you have it, guys. That was a deep dive into the world of project appraisal techniques. Remember, understanding these concepts can be the difference between making a smart investment and, well, not so much. By using these techniques, you'll be able to analyze potential projects, identify risks and opportunities, and ultimately make informed decisions that align with your financial goals. If you found this video helpful, be sure to give it a thumbs up, subscribe to the channel for more financial insights, and don't forget to hit that notification bell so you never miss an upload. Until next time, stay informed, stay invested, and keep crushing it.